Now it's time for another intriguing panel discussion on a very interesting and apt topic, coping with the funding winter. Our first panelist is Ms. Kitty Agarwal, partner Info Ventures, board member policybazaar.com and DotPe. As a partner at Info Edge Ventures, Ms. Agarwal contributes to the firm's mission of supporting innovative technology startups and fostering entrepreneurship in India. We have Mr. Videt Jaiswal as our second panelist. Mr. Videt is founder and CEO of Airblack, a startup focused on providing personalized online learning experiences. We have Mr. Rakesh Gupta as our third panelist. Mr. Rakesh Gupta is the managing partner, banker at LoEstro Advisors, a financial advisory firm based in India. In his role, Mr. Gupta oversees the operations and strategic direction of the firm, working closely with clients to provide banking and financial advisory services. This session will be moderated by Mr. Anand Sudarshan, founder and director of Sylvant Advisors, which provides strategic advisory services in the education sector to Indian and global institutions, large enterprises, and investors. Additionally, Sylvant incubates, invests in, and advises startup and early stage companies. Mr. Anand Sudarshan has made significant contributions to Manipal Education. He was CEO and Managing Director of Manipal Education. During his tenure, he saw various initiatives and developments that enhanced the educational offerings and overall standing of Manipal Education. Mr. Sudarshan is a board member of NIIT since 2012. This is going to be a very interesting session. May I request the audience to type in their questions in the chat box? They will be answered at the end of this session. Over to you, Mr. Sudarshan, for further deliberations.
Thank you, Neha. Much appreciated. Good evening, fellow panelists. It's a pleasure and privilege to be with all of you and talking about this very intriguing topic, coping with funding winter. And what I thought we could do is to we started 5 minutes late. We have time till 4:30. With the organizer's permission, maybe we'll go 5 minutes more depending on questions. We'll keep our discussions going till about 4:25, 4:20 to 4:25. And depending on the questions that come up, we will expand and take the questions as well. Is that okay with all of you?
Sure.
Yeah. All right. So let's start. The topic is interesting. Coping with funding winter. What's clearly evident to everybody that after the extraordinary amount of interest that was there in funding edtech companies in 1920, even 21 to some extent, I think there has been a drop-off in interest in 22 and 23, 23 in particular. And I'm not sure what the scenario is like right now. And we'll hope to hear from the panelists as we speak. Now, when I was looking at all of this, I was asking myself a question: what is this funding winter all about? So I'm going to ask Rakesh to set the ball rolling, speak about funding winter and what is his view, since he's the one who is in touch with both a whole bunch of entrepreneurs as well as with investors. Maybe a broad overview from you would be most useful, Rakesh.
Sure. Thanks, Anand. And hi, Kitty. Hi, Videt. Hi, everybody. Very interesting point, and I think this is a conversation which keeps happening with potentially every client that we have met over the last few months or quarters, I would say. Um, I think the way to think about it is that, like you mentioned, I think in the previous conversation, Ashwin was mentioning as well, that there is a lot of doom and gloom that is being talked about in the market right now. I think beyond the popular press, we have to kind of just think about really what's happening on the ground, right? I think there was an excess which was there in 21 and 22. I think there's a whole bunch of, let's say, capital which flew into companies in those specific years. I think a lot of companies which possibly were not very, very attractive from a fundamental point of view also got funded. And hence the mindset became that every company which goes out and starts something, or every entrepreneur which goes out and starts something will get funded as well. I think the market has become a lot more rational now. I think investors have realized what's what's fundamentally attractive, what's sustainable, what's the right kind of businesses which will eventually make money. That reality check has come in, and hence to some extent the amount of investments which have started to get into the startup space has gone down significantly, right? I think if you look at numbers, we're talking about from the peak, the number of transactions which have happened in early stage has gone down by 1/3, both in terms of value as well as this volume, right? So I think we have come from an extreme case of high liquidity driven transactions happening in the marketplace to a situation which is more, I would say, realistic and more sustainable as well. And if you have to compare these numbers which have happened in let's say last calendar year as well as what's happening right now, this is aligned to what the long-term trend has been. Like if you look at what happened pre-pandemic, the number of transactions which are happening and the value of transactions which are happening are pretty much similar to what we have right now as well. So in my mind, I think this is a winter compared to the peak, but otherwise the good set of companies continue to get a lot of interest from the investors as such.
Very interesting. So you're saying it's similar to the kind of momentum that existed pre-pandemic is what you're saying. Very interesting. So is winter actually the right word to use here? Because from what you're saying, I'm just using my words here to interpret what he's saying. There is based on various factors, there was massive exuberance. And I dare I say, the exuberance also got directed in with funding happening in big time funding happening in a few companies. And that is now got back to, let's say, a little more rational, So is this actually not a good thing for entrepreneurs? I'm saying earlier, in the last 2 years, it's the big guys who are able to raise more and more money. Now you're saying we are back to the pre-pandemic days, and therefore, is this not good news for young entrepreneurs, growing entrepreneurs?
If you ask my personal opinion, I think this is the best thing that could happen to entrepreneurs, right? Because in a situation which is extremely liquidity driven, where there's capital available, which is not potentially rational, as an entrepreneur, I would kind of start taking bets which might not be the best ones, right? I would start spending time on businesses which might not really create value, right? And I will spend 2, 3 years, I will use the capital, eventually outcomes might not come out. So a more rational capital situation actually works for the entire ecosystem and specifically for entrepreneurs because these are young guys who have huge potentials, who have huge attitude to create new businesses, right? And they should focus their time and effort on the right set of stuff and not build businesses which are just driven by capital.
Fair enough. Well, I'm going to come back to this point with Kitty down when I reach that stage. And I'm going to add another element, Kitty, when I speak with you on this. But before that, let me go to Videt for now. Videt, how big is Airblack in terms of number of employees? How long have you been around? Can you just give a 30-second kind of intro?
So Airblack is about 70 people strong. We've been around for 3.5 years in the education space, and we help women take 3 to 6 month courses and upskill themselves in the beauty space. So they go on to become beauty entrepreneurs, launch a salon. We've been around for 3.5 years and roughly doing like 6,000 to 7,000 enrollments a year.
And I found from your site, you're doing beauty and culinary as the two areas. Culinary, I presume you do short programs, much like what you do in the beauty space as well. Very nice.
That's correct.
3.5 years. Fantastic. So you have been through the exuberance and the post-exuberance, it's like Diwali lights, and suddenly they are switched off. Your eyes become very dark. It isn't really that dark. It's just that you feel it is dark. You've been through it. And have you raised money in this time? And did you need money? Have you managed to raise money? Were there kind souls there who were willing to invest in your story?
So I think, Anand, before I answer that question, there's some agreement that I would want to express with Rakesh that, we were in the exuberant phase. And I would now use the word the rational phase that we have entered in. But what really hurts in between is the phase of reset. And we raised our last round in December because we would say that as an education company, we reset our mind frame 12 months back. And today, the entrepreneurs who are not feeling the pain are the ones who reset themselves from that exuberant phase to the rational phase. So that exuberant phase from the rational phase reset happened at the investor end, and as an entrepreneur, people who were able to adapt to that felt less pain. So to specific to your question, see, we did feel the pain in the last 12 months, because when you're pitching 24 months back, everyone, is taking a bird's eye view and saying, hey, you know what, there are these 2 3 companies that have become so big in such a short period of time. I don't want to miss out, and let me invest in the education space. Whereas 12 months back, the top 3 top 4 companies went through a lot of pain themselves, and suddenly the investor sentiment changed. So we felt that there were 2 sets of investors, right? One set of investors were what I personally call the FOMO investors, who suddenly realized that, what, I'm not missing out on something. And they fell back on the trail and decided to just quit investing in this space. But then there were the investors who were the first principal investors. And I personally don't feel there is any funding winter when it comes to those particular investors, because they are the folks who are rational. They are seeing that, hey, you know what, education is a long term play, and this reset phase allows only long term plays to survive. So for them, people as entrepreneurs who are invested in the long term business of education became very, very attractive. So if I were to sort of scope out the FOMO investors, there's definitely a funding winter. But personally, I spoke to like close to 50 investors in the last 12 months, and I can share that greater than 50% of them are rational investors, and there is no funding winter as long as you're building a long-term sustainable business as an entrepreneur.
Well said. Well said. Very well said. But let me ask you maybe a slightly controversial question, push you a little bit, if it were. Now, this word rational always is, when it comes to investing and companies and stuff like that, I've always found it very difficult to understand. When somebody is getting a 22 billion valuation, your company being valued at maybe $1 billion seems very rational to you. When that's not happening, and the so-called exuberance, what we spoke about, is not happening, something else becomes very rational. So rational is a very, it's dynamic and depends on what happens. So my question to you is this. When it's very understandable, entrepreneurs get driven by the valuation stories that they hear, pink papers, whatever they cover. My question to you is, as an entrepreneur, how much would you be able to balance between getting driven by stories of huge valuation that you're able to read on a daily basis in papers against the core thesis of building, which rational investors, as you were saying, who don't have FOMO, have always been looking for, with the core thesis of building a very strong company and a scalable company?
So I'm actually going to give a slightly unique answer to that question, and it's a personal philosophy, right? I mean, I've been on the other side also in the past. So I was an investor myself for 3 years. So one strong belief, at least when we were building Airblack and we are building Airblack, we've held is that whenever you raise funds, you make a promise. So suddenly, when you think about it in that perspective, you say that what's rational in the short term may not be rational in the long term, right? So a valuation is a number which a group of people decided, and those group of people are generally less than 10, and said this is what you're valued at. But when you think about something in the long term, at the end of the day, you are as good as your P&L statement, right? And at the end of the day, unless you are running an NGO, if you're a capitalist and you're running an enterprise, you have to deliver profits, right? And you have to be valued on profits. So we at Airblack have always thought, and I personally believe that if you're raising funds, you're making a promise. So if you end up raising a $10 billion valuation from a growth investor, you have to deliver a $100 billion company. The second pillar of my personal belief here is that most companies are education companies, and they're not technology companies in the education space. And if you try to hyper grow an education company like an edtech business, unfortunately, you're going to compromise on outcomes, and you're as good as your outcomes, right? So when you combine one with two, you do realize that, at the end of the day, a valuation is a promise. And if you can't hyper grow a business, you should make a sustainable promise. So that's my personal belief. I won't get into why certain people would be okay taking a round at a higher valuation or lower valuation. I'm 100% sure it's lucrative, definitely in the short term to do that. But long term, I do not know. I would not be able to fulfill a promise, one promise that I cannot make, right? So
Fair enough. Thank you. That was refreshingly transparent and honest, and much appreciated. I think that will be a great takeaway for a lot of entrepreneurs listening to you. Beauty, as you say, is in the eyes of the beholder. But often what happens is the person, the beholder is the investor, but the person who's being assessed is the one who's got these expectations of valuation driven by whatever she or he reads in papers. And that's the reason I asked you that question. Kitty, I'm going to come to you now, right? You heard both of them, right?
Yeah.
Rakesh is saying that it's actually a good time, right? And if I may add to that, if it's winter so far, quote unquote, spring and summer are not too far behind. Videt is saying there always been rational investors. You have a good story, you have a good execution plan, good approach, and a differentiated company, and so on and so forth. There's always been a good story. Is this true?
Yeah, so I think I would actually agree with both of them. I would also distinguish, between late stage and early stage investing here,
Right.
because I think in the environment today, growth and late stage funds seem to be more scarce than the early stage funds, because a lot of the growth and late stage investors were those who really paid ahead of the fundamentals of a business, and now they are busy managing their own portfolio or kind of focusing on other markets apart from India. So India traditionally has not had very deep domestic pools of capital in late stage, which is why I think the scarcity of funding might be more pronounced in the growth and late stages. Now, if we come to the early stage, I would completely agree. I think all investors, pretty much all the big funds, we are all sitting on a lot of dry powder in terms of money. So there is no constraint there in terms of intent of deployment. I think the bar for the kind of company or the kind of founder you want to fund today has just probably gone higher than it was in 2020, 2021. And that I would say is a good thing, because once you are looking at it more from the perspective of fundamentals, and is this really solving a problem, are the unit economics strong, how does this look long term, it can't be just a COVID fuel thing of offline to online and tomorrow suddenly offline centers open and the behavior shifts, right? So something way more fundamental than that is being solved through, let's say, the online medium, or even if it's an offline startup or a SaaS startup. So I would agree with the two of them that we've seen founders come in with great set of numbers even at early stages, and this is happening across sectors. I think we're talking about edtech here because this is an edtech summit, but this is happening across sectors. So founders who are operating in edtech should know that it's not just that the bar is high for them, or the fact that their peers, if some of them go down, they are going to have a harder time. I think across sectors the story is the same, but the intent, of course, is there to deploy. So founders who are building strong businesses, who know what they are doing, are capital efficient, I think they'll have a decent time.
Fantastic. So this is what I heard you say. Number one, there is money. There is lots of money for early stage.
Yeah.
Late stage is a different matter altogether because most of the money comes from overseas. That's a different game for various reasons. We won't stand and analyze that. We'll stick to the early stage for the moment. And I would say early growth as well. It's early stage, it's early growth as well, right?
Yeah.
And you also said that, therefore, you will look at fundamentals, which is it a sustainable story? Is it scalable? Are the unit economics good? What else do you look at as fundamentals from entrepreneurs, Kitty? Besides these, this is about the story of the business. What else would you look at them?
For the founding team, also, that also plays a big role. So whether there are complementary skills amongst the founders, is someone really good at product and tech? Is there another person who understands sales, GTM, the right partnerships, has a good understanding of the customer? So I think complementarities in skill sets amongst founding team members, their resilience. I think this environment has brought another factor to the table for us, which is that when the funding dried up, or let's say you had a certain amount of capital you raised and you knew the environment was going to become sort of drier, then what did you do with it, right? So did you take the right calls? Did you right size teams? Did you focus on what was important? Did you make hard calls in terms of cutting out unprofitable businesses? And even where top lines have gone down but economics have gotten better, I think founders across the board pretty much are being rewarded. for the fact that they took the right calls, got the business to a shape and form which is way more sustainable. So I think in addition to the business's characteristics and the market characteristics, we are also looking for these softer checks in terms of how founders behaved or what actions they took when they were in some sort of trouble.
Excellent. Excellent. I said that I'll ask another thing with you when I was speaking with Rajesh. I said I'll come back to you one. In addition to the story, in addition to the other stuff that you spoke about, I believe one of the reasons for the excesses of the previous years, at least the negative, there's one reason, which is crazy valuation. And crazy valuation is always bad. No questions about it. And it happens. It happens. It's happened many, many times. But if you just look at the education sector in India, I mean, the number of companies that have blown up, public or otherwise, private, it's unbelievable, actually. It's I compared that with actually fintech, and I actually did that exercise, comparing with many other sectors. Education has been spectacularly different. You know, you have the NIITs on the one hand, public companies which have held on to a very strong set of governance. But then you have so many others. I won't name them because, you know, or maybe I should. We had Educoms and Everons and others which have exploded, imploded, whichever way it is. That brings me to a fundamental question. And I'm also, you know, drawing on the recent experience of a highly valued company and then the current strife that is happening between the investors and that company at the moment. And then I'm asking myself the question, what were the investors doing? If that company needed governance and governance was absolutely critical, what were they doing? Now, that's a very large company, leave that aside for a moment. So my question is actually more, this is one question, but I'm flipping it to our, you know, context, which is how important is your involvement, your as an investor's involvement and your contribution to building the edifice, the foundation and the edifice of governance in a company, and how important do you think it is? On a general basis, we'll say it's very important, but on a more practical basis, how important do you think it is?
So, you know, Anand, honestly, I would say the investor can only be a guide, right? We at InfoEdge believe that governance starts and ends in the head of the founder. Because uh, as outsiders, even if after you've invested in a company, you're not operationally involved and you are only going to attend so many board meetings or have so many conversations with the founder, and you only get to know what you're being told for the most part, right? And you can always guide and advise. I think it's a investors duty to not just look through things even if the business is doing well, right? So we often have a tendency that if the business metrics are going well, you don't want to tell the founder something that he or she does not want to listen because you're scared of being kind of shut out, right? Different founders have different reactions, and you just don't want to touch a ship that is sailing really well in terms of numbers. But I think that's sort of the wrong approach, and that's what ultimately leads to a lot of downfalls. Because if you as the investor, at times you can talk a lot of reason and you can give alternate truths to the founder, you can be a partner with them in terms of brainstorming. But again, I would still go back and say it's up to the founder to understand how much to grasp from those conversations, and where there is an intent issue or where there is just a very lax attitude towards these things, we've generally found it very difficult to fix.
You're the shifu, as the Chinese would say. You know, you're the guide who will be there to guide. And I mean, I'm totally buying what you're saying. If the intent is not honorable, and I'm not for a moment insinuating any of our audience here, these are a great audience that have been curated and brought in. But there are other entrepreneurs outside who may not have the right kind of intent. And the intent is not there, and the absolute commitment to embrace good governance is not there. I think eventually things will fare. And you as an investor would be always available to guide and help the company at every stage of its growth, even through the good times, certainly through the bad times as well, as a part of what you're saying. Okay, so here is, I'm going to ask a very, very quick question to all the three of you. Videt, I'm going to start with you. Kitty, after that, I'm going to come to you, and after that to Rakesh. Very quickly, tell me three things, only three things, that based on the excesses that you have seen in the last few years, and the little vacuum, drop that you have seen after that, and your own experience and what you have seen entrepreneurs go through, what are the three lessons or three points that you would recommend to the edtech entrepreneurs sitting in the audience to take away from all that experience? Videt?
So I think I'm going to bucket this in a slightly operational manner, so that a few of our fellow founders can at least take away my personal learnings. Those are derived from the mistakes that we made, right? The first is like more focused on product, which is everything boils down to thinking about yourself as an education company, and hence your job is to make sure that your learners are successful from day zero. So you're as good as the success of your learners. Second one, I would say, is more marketing driven, which is use digital marketing as a way to quickly experiment and go from zero to one. But as soon as you find that one, make sure that you're not dependent on digital marketing to grow your business. Again, very operational, but ensure that if you have a great product that makes learners successful, you find many ways to make it reach the masses and not just be dependent on digital marketing, because it's a fuel that can take you to zero very quickly. And last one is very related to sales. Make sure that if you have an enrollment team, they understand that they are responsible for changing lives. We use the word sales targets, we use the word RNRs, we run it like a sales company, but at the end of the day, they are counselors and they're going to change someone's life. And that responsibility needs to come top down at a cultural level. So I think these are the three things that I leave people with.
Great. So as Spider-Man's uncle told him, with great power comes great responsibility, right? So it's absolutely something that you have to do. He's talked about focusing on the learner. Okay, great. Wonderful to hear. Kitty, I'm going to come to you.
So I would say three things. I would say actually one is that just like people are being creative in terms of how to navigate the environment or being creative in their GTMs, etc. Today, the environment also affords us things like the SME exchange, right? Where lots of IPOs are happening. There are very good ways now to actually create value for yourself and realize value for your angel investors or for your smaller shareholders, etc. You do not necessarily need to keep raising lots of funding or have big names on your cap table to make a good outcome for yourself and for your shareholders. Case in point being, I think a company called LoEstro, right, which recently listed at a phenomenal valuation on the SME exchange, hadn't raised, I think, much, and it's a great outcome for the founders and everyone involved. So I think that is my first point, that you don't necessarily need to go down the traditional VC route and keep raising, etc. The second thing is, I would echo with its point that edtech specifically is a sector where outcomes are very important and you're impacting people's careers, you're impacting their lives and what they're going to do after they take your product. So marketing can't run ahead of product in edtech. We've seen some of the pitfalls of that in a few other cases where marketing and sales kind of ran ahead of outcomes, product, no matter what was happening there. Liquidity fueled the marketing. And so you kind of see numbers in the short term, but when things come crashing down, especially in subscription businesses where you're taking money upfront and you're delivering later, and your delivery is not as good as you promised, I think it can be a pretty vicious cycle. So do not let anything else get ahead of product and outcomes in edtech. And the third is, even if you raise funding, to all the founders out there, do not get pressurized into growing at a certain rate of growth which your business may not be able to afford, right? So a lot of businesses, especially those who are so outcome driven, are need to be run at a certain pace and scaled up at a certain pace. Now if you're going to try and go faster, inevitably, more often than not, a lot of things might get messed up. So my third sort of learning and advice to those here would be that play your own game, do it at your own speed. There's a lot of time out there in the world. Don't be in a hurry. And if you're at it for 10 years or more, 100%, nearly 100%, I can tell you from my experience, you'll make something or the other out of whatever you're building.
Absolutely agree with you. Absolutely agree with you. Rakesh.
Yeah. So, Anand, my first point would be, I think we have this possibly a lazy attitude of considering edtech as one particular sector. Honestly, edtech is a collection of multiple different sectors put together, right? I mean, if you look at edtech for K-12, that's very different from edtech for test prep and edtech for, let's say, higher ed, and edtech for skilling, upskilling, reskilling as well. I think what applies for one part of edtech doesn't apply for other side of the edtech as well, right? I think the macros for, let's say, a K-12 edtech is very, very different from a skilling, upskilling, reskilling edtech. And I think they've behaved very, very differently post the pandemic as well. So I think it's important to kind of really figure out which segment of edtech are you playing in and what applies there. And that might be very different from another edtech company, which is in a slightly adjacent space as such. So I think it's important. And a lot of times, I think we've seen founders which have said that, okay, if it's happening in X company in this manner, I can actually apply that in my business as well. And that becomes a bit of a challenge. So that's one thing. For example, I think if you have to have an edtech product which goes and sells to schools, it's a very different ball game than it's essentially a tech that you're building for, let's say, a B2C higher ed upskilling kind of a business, right? So that's one I think which is important kind of thing. I think again, going back to what Videt and Kitty was saying, that don't get lost in vanity metrics. The metrics for education is outcomes. If you deliver outcomes, that's most important. Enrollments, completion rates, none of them are important. If you are delivering outcomes, which in case if you are a company which is into tech skilling and promising a job, you should be able to show a placement rate very clearly to your customers. So that's the second part there. Third, I think at least in the pandemic side, we saw a lot of edtech founders kind of thinking about building businesses which will serve customers right from preschool all the way to grave and beyond as well. I think, and that's you can't do everything. These customers and their expectations are very very different. So focus on your core, focus on what's really you are offering to your customers, and then the rest of the things don't get into empire building and trying to build everything for everybody.
Great. Thank you. And I think all these are extremely valid points. I hope the audience was listening to these with keen interest, because these are outstanding points that have come as suggestions. We have a couple of questions that have come up, but before that, I want to spend maybe 3-4 minutes very quickly discussing, maybe first with you, Rakesh, and then with you, Kitty, a point which is relating to raising. We have been talking really about equity funding so far. Most of what we've been talking about, or almost all of what we've been talking about, is equity funding. Are there alternate funding that young entrepreneurs should look at, who are very early stage to the early growth stage? Are there methods that are available? If you can quickly keep it to maybe a minute or so, Rakesh, and then Kitty after that.
No, I think, Anand, I think clearly necessity is the mother of invention. Over the last 12 months, we have seen very interesting mechanisms which founders have used to raise capital for their growth and expansion. Well, I think one of the things we have seen is that people have started to divest non-core assets. I think you can see examples, at least 2 or 3 examples, where people have said that this is not core to my business, this is generating decent cash flows, but I don't think it will fit in my long-term story. So I will divest this, that will give me capital and that will help me grow. That's one which has become quite prevalent. Second, I think we have seen a lot of edtech companies. To give you an example, a company called Kutuki based out of Bangalore, who have started to think about licensing their content or their IP for other businesses who can distribute and provide them, let's say, the required amount of funding for the growth and expansion as well. So that has become another mechanism for people to look at essentially capital for their growth as such. Venture debt has obviously been there in the market for some time now. I think that ecosystem is becoming deeper and deeper as we speak as well. And finally, I would also think that there are, if the business is generating a decent amount of revenue, I think there is a revenue-based financing model, which is more suited for, I would think, B2C companies and more tech companies. But there is a revenue-based financing companies which have come up as well, who are providing capital. So I think asset monetization starts with that, licensing your IP if you can, find alternate ways to generate capital for that, venture debt, and then revenue-based financing are some of the things that we've seen in the last 1 month.
Thanks, Rakesh. Kitty?
So, Anand, actually, I'm going to take a couple of minutes here because I sort of have a different view on alternative methods of financing. We are also investors in one such company, and there are lots of these options for venture debt and RBF and whatnot that have come up, all kinds of structuring happening in the market. But in general, my view is that, I have also seen a lot of founders go into debt and, sort of they get stuck in a tough spot if they are not able to raise equity to balance out the debt or to balance out these other forms of financing, because they are all pseudo debt financing options where essentially the lenders run down the debt with your cash flow or with your equity going down, right? So in general, at least at InfoEdge, we really advise our founders to not obtain these methods of financing till they really need to. I know they're pitched like growth levers, alternates to equity at times. Equity is so expensive. Why don't you take this cheaper debt? But I think only for businesses that are profitable and sustainably so, where the cash flows can pay for the interest charges and can run down the principal payments over time. I personally feel only for those businesses is venture debt or RBF or other forms of alternate financing a good way to kind of navigate your situation and funding requirements. Otherwise, my suggestion is to strictly minimize these instruments.
Okay. And I would agree with you. There is one instance of a company that I had made early stage investments in. They were growing well pre-pandemic. They had their cash flows were good. They had the courage to expand by taking on debt. They needed to take, and they felt that this is a good time. And then the pandemic happened. And their business model, from whatever the revenue was at that time, came down to zero. Zero means zero, right? And the next 2 years, till their business came back again. I mean, to their credit, they kept at it, fought the way, and somehow kept the team together. Didn't lose anybody. Extraordinary, commitment from the entire team and the entrepreneur. And they are back in action now. Cleared their debt. Did not default. Fantastic, actually. But boy, I have seen them go through absolute hell, and that takes away from the focus that you have to keep on your company and growing the company. So yeah, I couldn't agree with you more. But
yeah, I've also seen, Anand, similar examples I have seen in my portfolio. Also, I've had 3-4 such instances where debt, that sword hanging on your head is just this constant reminder of the fact that you need to pay down the money while a lot of things are going wrong in the business, right? So that added pressure just makes it so much more difficult. And I feel like a lot of founders might say that debt was our only option. But if you are creative enough, or if you are just willing to be a little more patient, take out a little more profits, work with your cash flows, then either you could have done with a lesser amount of debt, or you could have done without it
without
altogether.
debt. Mm-hmm.
Yeah.
And I think the times where alternate instruments which are predicated on flow, and the returns going with the flow up or down, as the case may be, are still not in India available yet.
Yeah.
But I think at some point in time will come in. But I agree with you. Those are all for companies whose cash flows have stabilized and they are beginning to grow. And if you don't look at your cash flow, you're in serious trouble. What we'll now do is to quickly take a couple of questions. Videt, the first question is to you, which is if you said digital marketing, be a little easy, be a little careful, because it can really take you down a tube. If not digital marketing, one of the audiences asked, what are some of the other options that are there?
I mean, I think at Airblack, in the last 1.5 years, we've been able to become one of India's largest kitty party platforms. So we do like counseling sessions offline, and we call like a small group of women, make them aware about entrepreneurship and, motivate them. But we took a leaf out of the playbook of, other education institutes where, they would tap into residential societies, tap into schools, tap into universities, do B2B partnerships. But it, of course, has, a longer return cycle. You have to invest a lot upfront in the form of time to build these distribution channels. And digital marketing, of course, gives instant results. So that is the reason, I personally consider that digital marketing is great if you have to, go from 0 to 1 and figure things out quickly. But beyond that, it's not a variable in your control. So you have to have a diversified engine which goes beyond digital marketing, like the ones that I just said. And if anyone has to, I personally found this framework pretty exciting, that look at other education institutes in your own domain, specifically the ones that are bootstrapped, and they've figured out the best distribution channels already. So just look on the ground with people who have less capital, and they're finding ways beyond digital marketing to grow their business, and you don't need to completely rely on innovation all the time.
Thanks, Videt. I couldn't agree with you more. I come from an older era, and feet on street. Later they called it activation. In our days, it was not called activation. they called it activation. And today, of course, we are in the era of digital marketing. All I can say is, if you get down to the field and then start looking at avenues depending on your product and what is it that you have to, and who is it that you have to address, there are a remarkably large number of, one of the companies that I had very early on co-founded, we didn't have any money. And the only way we could promote the company's brand name was to put these reversible stickers on cars. It was a case study at that point in time, but that's the only thing that we could do, because collectively we had a total of 1.2 lakhs available for promotion. And when you are in a stage like that, then you really come up with some good ideas.
But
sure.
Having said that, quick 1 second, disclaimer that one should take this with a pinch of salt. We definitely relied on digital marketing for the first 1.5 years of our business. But as you scale the spends, the cost become uncontrollable. So it really depends on the stage of the business.
Really depends,
The proof in the pudding is to realize when to switch.
Absolutely correct. I agree with you. Just a quick request to audience. I have 2 more questions which I'm going to ask. If you have any other questions, very quickly in the next 30 seconds, pound them away. And so we'll try and see if we can address them. Kitty, the next question is for you. This is it's an interesting question. I think a lot of people will be asking, is it possible to raise funds over an idea?
Yes, I think it is. A lot of people do, but the team needs to be exceptionally strong. And and why they are doing that business, or the founder market fit or the founder business fit, needs to be really strong. At least if you're trying to raise from institutions. I think if you're trying to raise from your network, so friends, family, angels, all of those, then the rigor to which they kind of subject you in terms of what you're trying to do, why you're doing it, what is the final outcome, how many years out, all of those, how much capital will you need? I think those questions usually do not come about. So you might have an easier time raising from your network first based on an idea. But if you're coming to an institution, you need to be really sure that they're going to be sold on the founder and why he or she is doing this.
I also suspect that if the founder has had a prior track record, it becomes a little easier to raise funds over an idea.
Yeah,
Would that be right, Kitty?
100%. Because second-time founders who've at least had some sort of success with their first startup, or did something really big in the first startup, usually have an edge for sure.
I'm going to ask you a question, Rakesh, which is relating to whether it's funding winter, spring, summer, whatever it is. At the end of the day, on a constant basis, companies would need to raise money. At different points of time in their lives, they have to raise money. How important it is to build investment banking relationships? I mean, the obvious answer would be yes, but if you can just go beyond that and look at it in detail and tell the entrepreneurs the advantages, if there are any, to build longer term relationship with the investment bankers, so this process of fundraising becomes an easy exercise.
Well, I think it's quite critical, right? I think it makes the job of a founder a lot more easy if you are in touch with bankers, because as bankers, we are constantly in touch with most of the investors. We understand what really is going on in their mind. We understand at an aggregate level what are they looking for. We understand essentially which investor potentially has an appetite for what kind of businesses. So to a great extent, the bankers have the intelligence available, aggregated in one place. And once you have those relationships and those conversations with variety of bankers in the in the ecosystem, that allows you to kind of form your own view and build your own strategy around the fundraising plan. They will give you a broad view around whether capital is available, not available, what terms. They will give you view around what kind of investors to focus on. So I think to that extent, it's very critical. It just makes your life a lot more easier when you go and hit the market eventually, if you have all of this intelligence being provided to you in the conversation that you have. And then what also happens, I think, is that once you're in touch with the bankers, I think the bankers also get approached by investors for specific kind of companies that they want to invest in. And if I'm aware of a company and I know that a founder is doing extremely good work, I think that company kind of bubbles up in the conversation as well. So your own marketing to the entire investment ecosystem becomes a lot more easier in that.
fair enough. I think the other advantage that comes also is the fact that if the investment banker keeps working with the company over a period of time, the banker understands the company and then gets into which helps the investor, the new investor, a lot in conversations. In addition to obviously talking to the company and in getting whatever information, relationships, I think the investment banker also provides a very valuable perspective. One last question, and I'm putting this out to all of you. This is from one of the audience members. Is 100% AI tutor, do you see it in the future? And when do you see it coming, if you do?
So maybe I can go. Okay, sorry.
Yeah, go ahead, Kitty.
So I think, 100% AI tutor I see it coming for sure, but I don't know if that tutor is going to be relevant for all kinds of students, right? So because in a student, usually when he or she is prepping for an exam or for a class exam, etc., whatever it is, competitive exam, a lot different students have different kind of motivations, right? So the really motivated ones are okay being self-guided, and they can work with an AI tutor, and they're probably smart enough already doing their own work. But then I think the majority of students are those who need to be constantly pushed, motivated. Their questions need to be answered. At times they need to go back to the fundamentals. You kind of customize the plan a lot. The best tutors do that, and that's how you work with a large majority of the students. So I think an AI tutor will come for sure, but how relevant is that tutor going to be for the students out there? If it's going to be relevant for everyone, I'm not sure.
Rakesh?
Yeah, I think I kind of agree with what Kitty is saying, right? I think the entire learning process is not just about the person who's teaching you, right? It's also about the motivation. It's also about the environment. It's also about the discipline which is there. I think one of the biggest challenge with the entire online way of learning has been that there's a large chunk of population of students who are not motivated enough to sit in an online class and learn on their own speed, right? So that's the reason that you will have AI tutors and it will work for a bunch of people, but for a large population, I think a pure AI tutor might not completely work. You will still require physical intervention. You will still require discipline, motivation, which has been brought, which has to be brought by teachers specifically.
I agree with you. There is a significant asymmetry between the discipline that's needed for most learning and what the net or AI or any of the technology really offers today. And till you bridge that asymmetry, which is some distance away, I think nothing will be a problem. With it, I'm going to give the last shot to you. Would you teach women beauty, your young chefs, culinary? Would you teach it entirely using AI?
I find it tough. I would borrow this quote that I read online, which is like, content and knowledge is in abundance, intent and discipline is not. And I would want to sort of apply that to us as well, that in our case what really works is bringing people online and in a 2-hour workshop, taking them step by step from 0 to 1 and making them create something. And I can tell you for sure that whatever they learned and they know it is also available on YouTube, right? But what really gets the learning going is getting them together and getting them to do something together, which is very, very important in a community like ours. And as Kitty said, that maybe it will work for certain kind of audience, but for the other kind, it may not. And maybe my belief is that we are from the other kind, and it may not work in our segment completely.
And Kitty also said it may work for certain kinds of learning, may not work for certain other kinds of learning. And I couldn't agree with Abo. Thank you very much, my fellow panelists. I hope the audience has had as much of a takeaway as I've had. I think the biggest takeaway from my side that I would like to leave the entrepreneurs is that there is nothing like a funding winter and things like that. It is like what it was prior to the pandemic. The exuberance of the pandemic is over, and then we just have to come back to the reality as it exists today. Focus on your business, build a great business. I think funding will happen. Thank you very much.
Thanks, Anand. Thanks, Rakesh.
Thank you.
Thank you all.
Thank you.
Thank you all for such an engaging discussion.